Hey there. Ready to master the markets, but also, still have a weekend.
That's the dream, right? Weekends for living, weekdays for winning? Well, maybe not that simple, but Nick Radge's Weekend Trend Trader makes a compelling case.
It does. It's all about, finding those stocks that are ready to climb, but only checking the charts once a week. Perfect for those of us with lives, right?
Exactly. It emphasizes a really systematic, rule-based system, which I know appeals to a lot of people.
Totally. So let's dive into it, shall we? What tools do we need? What's in our trading toolkit, so to speak?
Well, Radge highlights two big ones. First up, reliable analysis software. Now, he's a fan of Ami Broker, but I know plenty of folks have their favorites. The point is, you need something that can do some heavy lifting, right? Scanning for setups, maybe generating signals based on your rules, that kind of thing.
Yeah, like a trading assistant to handle the boring stuff.
Exactly. The second thing you'll need is, of course, a broker platform to actually place those trades.
Got it. So assuming we've got our tools all set up, how much time are we actually talking about investing in, the weekend part of this weekend trend trader?
See, that's the beauty of it. This strategy revolves around a weekly time frame. You analyze things over the weekend, place your trades, and then boom, you let it ride for the week.
I like the sound of that. No need to be glued to the ticker tape every second of the day. So how do we find those winning trades? Where do we even start?
Okay, so the trend in Weekend Trend Trader is super important here. Radge is all about that long-only approach. That means we're buying stocks we think are going to go up. And the key is aligning ourselves with what the broader market's doing.
Right. So no jumping on a stock just because it looks like it's about to take off. We got to look at the bigger picture, right?
Absolutely. He uses the S&P 500 index as a gauge, applying a 10-week moving average. Think of it like this. If the S&P 500 is above that average, the market's generally going up.
So we're looking for stocks riding that wave, those upward trends. But how do we pinpoint the strongest contenders, the ones that will really benefit from that market upswing?
Good question. We look for stocks breaking out to new highs, specifically 20-week highs. That shows us some serious upward momentum.
Okay, new highs, got it. But isn't there a risk of getting fooled by those whatchamacallit false breakouts? Those little jumps that don't actually lead anywhere.
You're absolutely right. To avoid those traps, Radge adds another layer of confirmation, and this time he uses a momentum indicator called rate of change, or ROC for short.
ROC, all right, I'm intrigued. What does this ROC tell us?
Think of ROC like a power meter. It measures how strong that upward move actually is. We're looking for stocks with a high ROC, something that shows us, hey, this isn't a fluke, this thing is really taking off.
Okay, so it's like a three-point checklist for entry, right?
Yeah.
Broader market trending up, individual stock hitting those 20-week highs, and a strong ROC to confirm it's all legit.
Nailed it. No room for emotional decisions here. We got to be systematic about it.
Love it. So let's say we've got our eye on a stock. It's checking all our boxes. Everything's looking good. But you know how the market is. Things can change quickly. So how do we know when to exit a trade? How do we protect ourselves if things start heading south?
Okay, so for exits, Radge, again, keeps things super disciplined with a two-step approach. Think of it as your safety net, making sure you don't lose your shirt if the market takes a turn.
Two-step approach. Okay. Hit me with step one.
Step one is all about a trailing stop loss. If the stock closes 40% below its highest point since you bought it, you sell. Might seem like a lot, but remember, we're only risking a small part of our portfolio on each trade.
40%. That's a pretty substantial drop. I'd be worried about missing out on some potential gains if it bounces back.
And that's a fair concern, but remember, it's about those consistent bases, not always swinging for the fences, Those small, consistent gains really add up.
Right, I get it. So step one is all about cutting our losses if things take a serious dip. What about step two? When does that come into play?
Step two is all about the bigger picture. If the overall market, our old friend the S&P 500, starts heading down, we tighten things up. Remember that 10-week moving average we talked about? If the S&P 500 dips below that, we tighten our trailing stop loss to just 10% below the stock's most recent weekly close.
So it's like we're becoming more cautious if the overall market sentiment starts to sour.
Exactly. Protecting our capital, especially when things get a little shaky out there.
Makes sense. Now let's talk about actually building a portfolio using this strategy. How many stocks are we juggling at any given time? Is there a magic number?
Radge is all about diversification. He recommends holding 20 equally weighted positions.
20. Okay, that's starting to sound like a lot to keep track of.
It's definitely more than picking one or two stocks, for sure. But remember that analysis software we talked about? That's where it really shines, helping you manage it all. By spreading our bets across 20 stocks, we're limiting the impact of any single stock on our overall portfolio. It's all about balance.
Right, like having a well-balanced breakfast. Speaking of which, any specific types of stocks we should be on the lookout for within those 20?
Good point. Radge recommends sticking to stocks that generally share a similar risk profile. Don't go mixing those high-risk, high-reward stocks with the slow and steady ones. Keep it consistent.
So no throwing a bunch of volatile penny stocks in with our blue chip companies.
Yeah.
Got it. But the real question is, does this thing actually work?
The million-dollar question, right? Well, Raj wouldn't leave us hanging. He backs up his weekend trend trader with some pretty solid evidence.
Yeah, I'm all ears.
He uses backtesting, which basically means looking at how the strategy would have performed in the past using historical data. But he takes it a step further with something called Monte Carlo simulations.
Monte Carlo simulations.
Yeah.
Sounds fancy.
A little bit, right. Essentially, they run thousands of hypothetical scenarios based on that historical data, giving us a much clearer picture of how the strategy might play out in different market conditions.
So instead of just one hypothetical timeline, we're looking at thousands of possibilities.
Exactly. It's like having a time machine, but for your investment portfolio. Gives us a much more realistic idea of the strategy's potential, both the good and the bad.
I'm on the edge of my seat.
Yeah.
What did these simulations show? Did the weekend trend trader pass the test?
All right, so for his test end ground, he used the Russell 3000 index, which includes a really broad range of stocks, both current and past.
They were still 3,000. Got it. So what happened?
Hold on to your hats, because the results were impressive. Between January 1995 and late 2012, which, remember, includes some big market swings like the tech bubble and the financial crisis, the weekend trend trader beat the S&P 500.
Well, hold on. Outperforming the market is one thing, but we were just talking about those major crashes. How did it handle those?
That's a thing. It not only beat the market, but it did it with less risk. Remember those trailing stop losses, that safety net we talked about?
Right. Always adjusting to protect our capital.
Exactly. That defensive approach made a big difference, especially during those downturns. It's about being in a good position to capture those gains when things are good, but also protecting yourself when things get rough.
So, potentially making above average returns, but also, sleeping soundly at night, knowing that we've got a plan to mitigate those major losses.
Yeah.
I like the sound of that.
It's about finding that balance, right? Growth and risk management, they go hand in hand. And that's a big part of what makes this weekend trend trader so interesting.
Okay, so I have to admit, I'm pretty intrigued by all this. But before we get too far ahead of ourselves, can we break this down into like a super simple summary, just the core ideas of the weekend trend trader?
Absolutely. First and foremost, it's all about riding the waves, not fighting the current. We want to be in when the market's up, and we use the S&P 500 and that 10-week moving average as our guide.
Right, our index filter. Green means go, red means, well, maybe not stop, but definitely proceed with caution.
Exactly. Second, we look for stocks that are on the move, those breaking through their 20-week highs.
So momentum is key. We're looking for those stocks that are showing strength and have the potential to climb even higher.
And then, just to be extra sure, we double-check that momentum with the ROC indicator, making sure we're not getting fooled by any false starts.
Gotta love that confirmation.
Yeah.
So we're looking for an ROC above 30%, right? Then what?
Okay, so once we're in a trade, it's all about managing risk. And that's where our trusty trailing stop loss comes in. Remember, 40% when the market's looking good, tighten it up to 10% if things start to take a turn.
Risk management, always. Got to protect those gains.
You got it. And last but not least, we diversify. 20 stocks, all equally weighted, all with a similar risk profile.
It's like building a well-balanced portfolio. So, to sum it up, the weekend trend trader is all about being systematic, managing risk, and of course, freeing up our weekends.
You got it. It's a compelling approach for anyone looking for a more hands-off, rule-based way to approach the market.
I'm sold. But before we get too carried away, I think we need to talk about those all-important caveats, those things potential investors should be aware of before jumping in.
Absolutely. Because, like any strategy, the weekend trend trader isn't without its risks.
Right. Let's dive into those crucial caveats and make sure our listeners have all the information they need to make informed decisions.
I'm happy to break it down.
Okay. So last time, we left off with our hypothetical Apple investment hanging in the balance. The market was getting a little shaky, and we just set that trailing stop loss at $81.
Right. Things were getting a little tense there for a minute.
They were. So, did our hypothetical investment weather the storm? Or did we have to kiss our Apple profits goodbye?
Well, let's say that even with the market dip, AAPL stayed strong and held above that $81 mark.
Ooh, that's a relief. Our trailing stop loss did its job. We're still in the game.
Exactly. It's like a safety net that moves with the market, protecting our capital without cutting us off at the knees at the first sign of a dip.
Love it. Okay, so let's say a few weeks go by, and the market, thankfully, starts to bounce back. Our index filter, our trusty S&P 500, is back in the green.
Okay, so things are looking up.
They are. Now, since the market's looking good again, do we go back to our original 40% trailing stop loss?
We do. With the index filter back in the green, we adjust that trailing stop loss back to 40% below Apple's highest closing price since we bought in. But, and this is super important, we never move that stop loss down, only up as the stock climbs higher.
Ah, okay. So even though the market dipped and we tightened things up for a bit, we don't lower it back down from that higher point. It's like we're always raising the bar, locking in those gains as we go.
Exactly. Always protecting those profits. That's the name of the game. Okay, so just for the sake of this example, let's say AAPL keeps climbing and hits a new high of, let's say, $110 per share.
Nice. Our hypothetical investment is looking pretty sweet right now. But with that new high, our trailing stop loss adjusts, right?
It does. It would then be 40% below that $110, which puts it at, let me see, quick calculation here, $66.
Got it. Got it. So the higher APL climbs, the higher our trailing stop loss goes with it.
Think of it like a safety net that rises with the tide. We're riding that wave, but we're always prepared if things start to turn south.
Okay, so fast forward a bit. What eventually triggers our exit from this AEPL trade?
Ultimately, it's going to be one of those two trailing stop-loss rules. Remember, either APL closes 40% below its high point while the market's strong, or it closes 10% below its recent high if the market's taking a dip.
Right, right. Two possible exits, both designed to keep us ahead of those big losses. Okay, so let's say, just for example, a few months down the line, AAPL has a rough week and closes at $100 per share.
Ooh, okay. Getting close to that trailing stop-loss.
Too close, because that puts it just below our trailing stop loss of $101.
You got it. And remember, no hesitation here. The weekend trend trader is all about sticking to the plan. So because it closed below our stop loss, we'd sell those shares first thing Monday morning.
So no waiting around to see if it bounces back. We're cutting our losses and moving on.
Exactly. Sticking to the strategy. That's key. So we sell those shares, and let's say the opening price on Monday is $99.
Okay, so we're walking away with a profit of about $20 per share. Not bad, not bad. Especially for a strategy that basically lets us forget about the market all weekend.
Right. It's all about that balance, making smart moves without being glued to the ticker tape 24/7.
Exactly. So we've seen the strategy in action, but I'm curious about the bigger picture.
Yeah.
You mentioned those Monte Carlo simulations that Radge ran. What kind of results did they show? Like, how did this strategy actually perform over time?
Okay, so this is where things get really interesting. We get to see how the weekend trend trader stacks up against the old-fashioned buy and hold approach.
Hit me with the numbers.
All right, so remember those years we talked about? 1995 to late 2012? That's a pretty volatile period in the market.
Yeah, we're talking tech bubbles, financial crises, the whole shebang.
Exactly. And even with all that craziness, the weekend trend trader came out on top with an average annual compounded growth rate of Roth Pipachu.
Mm.
Are you ready for this?
Give it to me.
15.42%.
15.42%. Okay, so for those of us who aren't, like, financial wizards, what does that actually mean? Put that into perspective for me.
It means that, on average, someone using this strategy would see their investment grow by over 15% each year.
Wow. Okay, so considering the market average is what, like 10% annually, that's a pretty significant difference.
It definitely is. And here's the kicker. The strategy managed those gains with a maximum drawdown of...
Don't tell me it's something crazy low, isn't it?
Okay, maybe not crazy low, but still pretty darn impressive.
24.08%.
24.08%. So even in the worst case scenario, during that whole period, the strategy never lost more than 24% of its peak value. It's pretty incredible, especially considering what was happening in the market.
Exactly. And when you compare that to the S&P 500's maximum drawdown during the same period, which was a whopping 57%, you really see the power of this risk management approach.
Right. So not only are we aiming for those above average returns, but we're also trying to avoid those big hits that can take like years to recover from. Exactly. It's about finding that balance, right?
Yeah.
Striving for those gains while making sure we're protecting ourselves from those big dips. And that's what makes the weekend trend trader so compelling. It's like having our cake and eating it too, but in a, financially responsible way.
Totally. Okay, so I'm starting to get a handle on this whole weekend trend trader thing. But before we wrap up, can we just distill it down to the the absolute key takeaways.
Absolutely. We can do a quick recap. So first and foremost, it's all about understanding that market trend, riding that wave. We use the S&P 500 and its 10-week moving average as our guide. Green means go, red means, well, maybe not stop, but definitely proceed with caution, like you said.
Right, or trusty index filter. What was next?
Then we're looking for those stocks with that upward momentum, those breaking out to new 20-week highs.
Momentum is key.
Absolutely. And just to be extra careful, we use the ROC indicator to make sure that momentum is legit.
Got to have that confirmation, right? So we're looking for an ROC above 30%, and then what?
Then, once we're in, it's all about managing risk with our two-step trailing stop loss. Remember, 40% when the market's looking good, and then we tighten it up to 10% if things start getting a little uncertain.
Safety net, always.
Always. And finally, we diversify across 20 stocks, all with a similar risk profile. And there you have it, the weekend trend trader.
Wow, I have to say, I'm impressed. This strategy seems like a really solid approach for those of us who, want to make smart investment moves without spending every waking moment glued to the stock market.
That's the idea. It's all about making your money work for you, not the other way around.
I love it. But before we get too excited about hitting that buy button, I think it's important to talk about the potential downsides, the things potential investors should be aware of before they dive in head first.
You're absolutely right. Every strategy has its risks and limitations, and the weekend trend trader is no exception.
Okay, so we've covered a lot of ground here, but I think it's only fair to talk about the potential downsides. Like, what are the things people should be aware of before they, go all in on the weekend trend trader?
You're absolutely right. We've got to talk about the caveats, because like any strategy, this one's not foolproof.
Right, right. So what are the risks? What are the limitations we should be thinking about?
Well, the first thing to remember is that, past performance, it's not always a perfect predictor of the future. Just because something worked well historically doesn't mean it's guaranteed to keep working that way.
Yeah, the market has a way of keeping us on our toes, right?
Exactly. And while the weekend trend trader, with that focus on trend following, it's designed to adapt to those changing conditions, there's always a chance that, the market throws you a curveball.
So it's not about like predicting the future. It's more about having a system that can handle those unexpected swings as best as possible.
Exactly. Another thing to keep in mind is that this is a long-only strategy. So it's really designed to profit from those rising markets.
Right, we talked about how it aimed to protect capital during those downturns, but it's not really built to, actively profit from them.
Exactly. And while that whole going to cash during a bear market, it can definitely help minimize losses, it also means that, you might miss out if the market suddenly rebounds. It's about picking your battles, I guess you could say.
Right, so it's a trade-off. We're prioritizing protecting what we have over trying to, catch every single up and down.
You got it. And that actually brings us to another really important point, which is this strategy, it takes patience and discipline.
The two things they don't tell you about in those get-rich-quick schemes.
Exactly. It's about sticking to the plan, even when, you see other people maybe making those quick bucks elsewhere. It's a long game.
It's about trusting the process, right? Even when it's tempting to, jump ship at the first sign of trouble.
Exactly. Because remember, emotions, they can really mess things up when it comes to investing.
No doubt about that. Well, I have to say, this has been an incredible deep dive. We really dug into the nitty-gritty of this weekend trend trader, looked at what makes it tick, the good and the bad. Hopefully our listeners are walking away with a much better understanding of how this whole thing works.
I hope so, too. It's all about giving people the tools and the knowledge, right? So they can make the best decisions for themselves.
Absolutely. And on that note, a huge thank you to you for sharing all this incredible knowledge with us, and to our Modern Amazing listeners for joining us on this journey.
Well,
Until next time, happy trading, everyone.